Reasons for loss in the stock market. 1. Lack of necessary training. So do not think that if you understand the market well after your work on the fictitious account and then enter a real account. 2. Lack of knowledge. Most new traders in currencies do not spend time to know and learn the basics of currency movement. Therefore, they must in this case when there is a date for the issuance of economic news or important statements to exit from the market by closing their open contracts and waiting until there is another appropriate opportunity to enter the market, and this is the best way for them to enter the market only when it is calm, and thus avoid random trading during the news and think about the technical movement of the market. 3. Repeated entry on the same day. When you set a short goal in the number of points and a reasonable percentage of the stop loss will make you achieve a few $100s per day. But increasing the number of entry times over and over again may make you vulnerable to greater loss. For entering in one lot with a large number of contracts, most companies give you a small margin to enter, and some believe that this is a good advantage. They entice you to enter in a larger number of contracts at once to get more interest from you. Remember that when the remaining amount of your account for use in the margin drops to zero, the program will automatically get you out of the market immediately and close all your contracts, and you bear the loss. 5. Dependence on others in decision making. Often, professional shops act unilaterally and make their own decisions and do not depend on others to make decisions. There is no halfway or car with drivers. Either you are the one who trades or there is someone who trades for you. 6. Misuse of stop-loss orders. Putting stop-loss orders in a location close to the market price makes it feasible at any moment. And this often guides you a lot of programs, because in the end they have benefit and you are the one to lose. 7. Misuse of demo accounts. Most of the demo accounts are closer to a games program and are not sensitive with the price change in real time like the actual accounts, and give you the impression of the possibility of making a profit, especially during the limited movements of the market. And once you move to the actual account, you will discover that the psychological state when dealing with imaginary capital is that you are free from any fear of loss, and your ability to adventure will be limitless. And once you move to the truth and enter the market and face any loss, your psychological state will change forever. Dealing with a demo account is recommended to only gain operational experience in how to execute orders, as it knows bad habits of how to treat money as a game. Loss means nothing to you. Starting with a real account teaches you how to avoid loss. 8. Trading during stop hours. There are hours during the day that separate the official markets between each of Asia, Europe and America. Banks and huge investment funds benefit from them and pay prices to numbers they wish to make their deals with, as there is not a large volume of traders, and who goes victim to that are the small traders when they hold contracts outside the market price range. 9. Trading without a plan. Profit making cannot be a day is the plan for trade. The trade plan is the work program for success, and you must define your goals from the market, and if you do not have a goal, this means that you have no plan and will lose in the end. There is a statistic that 95% of the losers exit the market because they do not have a plan. 10. Trading against the market trend. There is a huge difference between buying at a low price before the market rises and buying at the